Now, Amit, the market has in fact kind of bounced back. It's currently in the green, and I can see Nifty is currently trading about 0.1% higher, but still struggling to break past that 19,550 sort of levels. Now, mid cap and the small cap indices, on the other hand, are still trading mixed. Rather, Nifty small cap 100 has actually reversed the trend. It's now trading in the red, although on a flattish note. Nifty mid cap 100, on the other hand, Amit, is looking rather weak. It's actually underperformed the headliners. Nifty mid cap 100 is down about 0.5% this morning. Also, taking a look at the sectoral indices, Nifty Bank, Amit, has been facing consistently resistance near that 43,800 sort of levels. Now, as we were talking about earlier in the show, the bank has tested those 2 months low, but every time it tests those lows, we have seen a good bit of a bounce back coming in the stock. Even in fact, on Friday, the stock opened sharp, Nifty Bank opened sharply lower, trading around those August lows, but we saw it, recouping all those losses, and it ended about 35 basis points lower. In fact, even today it opened lower, and it has again climbed about 0.14% or so at around 10 a.m. this morning, still below that 43,800 mark. Now, among other sectors, Nifty IT continues to be, continues to witness some pain. Nifty IT is down about 0.33%. Now, these numbers are as of 9:45 a.m. this morning. Nifty Auto, the earnings are expected to kick in, starting this week. Nifty Auto is down, up about 0.04%. Nifty FMCG is up about 0.23%, and Nifty Pharma is also trading moderately higher at about 0.46%. Now, without further ado, let's also bring on board our second guest, a regular on this show, Mr. Gaurang Shah, Senior Vice President at Geojit Financial Services. Amit, Ranjan continues to be with us in the studio. Now, Gaurang, I'll start with you. Great to have you on the show as always. Now, two banks reported their Q2 numbers. Looking at the numbers, the loan growth has been strong on a quarter-on-quarter basis, but I was reading some reports where it suggested that private banks have been expanding their branch networks lately, whereas public sector banks have actually seen a reduction in their in their branches. Now, I just want to understand, the loan growth that we have seen on a sequential basis, once that tapers off, will you be concerned about their operating expenditures?
Thank you, Suyash, and morning to all of you also. The merger process that happened in number of public sector banks getting merged into a larger public sector bank led them to, revisit their strategy in terms of branch network, and within a particular radius, was it viable to have two branches of the same bank after the merger. So hence, there was consolidation, and some branches which were not viable or which were very close to that particular kilometer of radius, that got merged into the other branch. So maybe, because of that, you might have seen a little bit of consolidation in branch network for some of the PSU names which went through that process of merger. But we as a brokerage house remain positive on four names primarily in the public sector bank universe. That is State Bank of India, Bank of Baroda, Canara Bank and PNB. Bank of Baroda and Indian Bank, we have a sell/reduce recommendation. And in terms of earnings and growth outlook, historically speaking, private banks have outperformed public sector banks by length and breadth. There is no denying. Even when it comes to return on investment for a common investor on the street, the bias towards public sector bank is definitely something that we can see absolutely clear. But we are also of the opinion that now with this entire merger process, cleaning of balance sheet, gross net NPA coming down, provisioning coming down, margins getting improved, eventually, Suyash, it will depend upon bank to bank as to what is their cost of borrowing and what is at what rate are they lending, and the difference between that is what is their bread and butter and jam. So I am of the opinion that you will see a steady improvement in earnings for public sector banks, the four names that I've mentioned, And same likewise, I think, if you just go by the kind of funds that has been generated by NBFCs and banks, purely because of the view that credit demand is going to stay here for a pretty long period of time. And when your credit demand is strong, your loan book growth is there, definitely your margins also improve. So we definitely believe that public sector will tend to outperform, but these names, four names, is what we would recommend fundamentally on the PSU bank side.
Now, also talking about banks, NIMs have continued to be under pressure. In fact, that's what we are seeing playing out in this earnings season. For how many quarters will that be a concern for banks going forward?
So, I mean, if I look a couple of years back and if I look at the present situation, I think there is stark improvement. And this improvement will only get better as we go forward from here on. So, when you are in the business of lending money, you have to bite the dust, at some time. Be it in form of gross net NPA going up, be in terms of a sudden spike up in that particular number because of XYZ corporate having difficult times. But does that mean that you have to stay away from the banks and finance? We don't think so. In fact, we also have the same opinion that strong and well managed small and microfinance companies, Suyash, will do extremely well. Likes of L&T Finance, Credit Access Grameen, AU Small Finance, Ujjivan Small Finance, Equitas Small Finance. All these micro small finance companies will do well. So, you have to kind of take it with a pinch of salt with an optimism that these things will improve as we go forward from here now.
Good morning, Gaurang. This is Amit Ranjan here. I have a broader question. Last week, the focus was on global cues, whether it was the unrest in the Middle East, rise in crude oil prices, or the bond yields that went up in the US. Do you expect the market focus to be on these very factors again this week? And which of the factors are you most concerned about?
Good morning, Amit. So, unless and until there is a decisive end to this crazy conflict that is going on in the Middle East between Palestine and Hamas, there were news that neighboring countries like Morocco or Iran, to a certain extent Turkey, and other nations wanting to jump into this fire. I hope that common sense and wisdom prevails upon those leaders and not to do anything stupid. And the reason why I'm saying this, because Iran is the second and the fourth largest producer of crude oil and natural gas. And one of the crucial supply pipelines to the globe is under Iran's control. So if there is anything that has to happen adverse, and the news flow from the Iran is from the negative side, then we'll have to worry. Already we are looking at $90 plus Brent, $88, $89 Brent, NYMEX, I beg your pardon, and with your rupee at 83 plus levels against the dollar. So these issues will bother the market, but the severity of that issue is now done and dusted. Unless and until we have, any kind of huge negative news flow of which we don't have any capability to assume or presume as to when and in what form it will happen. So markets across the globe, not only in our markets, market across the globe will react accordingly. Earnings is something that I think has possibly gone down well with the market, though we have seen some of it. A lot of it is yet to be seen. But let's hope that the second quarter has got a better shade and color to show us, and for us to possibly, assume that third and fourth quarter will be equally good and next year again will be better. The other thing that will trouble our market, Amit, is the 5-state election by the end of this year and the next big election in 2024. So I think these are some of the triggers which will be on the market's mind before we have any decisive breakout.
Now, Gaurang, on the back of this uncertainty that we are seeing in the global markets, gold has spiked to a 3-month high. I mean, I think it's around the spot gold is around $25 below the 2000, the crisis level of $2,000, about $100 odd from its all-time high levels. Do you expect gold to spike up to and reclaim those all-time high levels in this bull run?
I often get these questions asked by a lot of investors. And as a fundamental analyst and as a principle of investment, I have always advised that you at least keep 10 to 20% of your investable portfolio amount exposure to gold related assets. That can be in form of physical gold, that can be in form of gold sovereign bonds, or that can be in form of gold ETFs, which are almost about 12 gold ETFs. The last that I remember are listed on the National and Bombay Stock Exchange. And that's a good diversification also, and the principle of investment. Uh, Gold, whenever a situation like this has happened geopolitically, gold has jumped. I think it was around about 56,000, 56,500 before 7th of October, before this particular, unwise attempt by Hamas to attack Israel in a terrorist form, a terrorist attack. And then you saw how gold reacted, including silver. So we always advise that you have to, diversify your investment into different asset classes. And gold should be at least 10 to 20% depending upon your age, depending upon your risk appetite. And that could be in form of these. So gold, as and when we have these kind of situations, geopolitical situations across the globe, as many times you will see gold, bouncing on the higher side because of flight to safety. Secondly, gold is a natural commodity, Suyash. There is going to be an end to gold. And over the last 5 years, the amount of gold that is mined out of a gold mine is reducing. And the quality and quantity is also not up to the mark. But the operating cost, that is the mining cost, has gone up in dollar terms. So when you have these kind of situations, you tend to have a little bit of attraction towards gold.
Hi, Gaurang. Keeping to retail investors, now the markets after a strong run are showing signs of some exhaustion. Do you advise retail investors to book some profits given the global uncertainty right now?
I don't know what the next uncertainty will be, Amit, to be very honest, in which form and which part of geography in the world. So, when you come to equity market, you have to come with your arms wide open to accept the risk that are involved. And I always tell this to retail investors that if you don't have the risk appetite, please don't come to the stock market. And if you have the risk appetite, this is the best asset class, historically speaking, in terms of returns that has been generated. And I also don't understand why you should be shy of booking profits. Eventually, you come and invest in any asset class, especially in equity, thinking that your money will give you some return. You put your money to work. And in gold, I beg your pardon, in FD, in bank FD, you get 7.5%, minus tax, minus inflation, it comes to barely anything. And when equity markets are giving you 15-20% or maybe more, and you have the greed factor coming in. So you should not be greedy. You should have your goals set aside before you come to the market and invest. And whenever your goals are achieved, I think periodically you should definitely book some profits.
All right. Book your profits periodically and don't be afraid to book profits. If you are sitting on good returns, if your targets are achieved, book profits. Now, Gaurang, we are in the thick of the earnings season, kick-starting the third week. So far, Q2 looks like a repeat of Q1. I mean, banks are continuing their streak of improving asset quality and strong profit growth, while pain persists for IT. FMCG majors have also seen a muted top-line growth, while bottom line has expanded on operational efficiencies and softening of raw material prices. What's your overall assessment of India Inc.'s Q2 report card so far?
I think overall we should be good, Suyash. Monsoon has been erratic, let's face it. And for FMCG companies, demand from semi-urban rural India is of more priority rather than metro tier 2, tier 3 cities. And that's where you see the volume growth come through. But, Suyash, we have, of course, when in times of inflation, even you and me switch on to alternative products. But when the situation improves, we again go back to that high-end product and a little bit of lap of luxury that we want to live in. So, short term, there might be speed breakers, but long term, given the fact that India is a consumption-driven story, it was, is, and will always remain so. And you have a huge population, and 35% of that is below 30 or 28 years of age. And our sense is that raw material cost, which was a concern even last financial year, has come down to a great effect, not only for FMCG companies, but also for cement and for steel manufacturing companies. I think the input cost has come down. So you should see steady and gradual improvement in numbers. We have a whole host of companies in the entire FMCG universe, starting with your Dabur, beg your pardon, starting with your Nestle, Britannia, HUL of the world, going down to ITC, Tata Consumer, Godrej Consumer, Dabur, Marico, Imami, ITC, whole host of it.
Now, Gaurang, US Federal Chair Jerome Powell is due to speak again on October 26. In his last speech, he sounded rather dovish, talking about the strength of the economy. However, without saying it outright, Mr. Powell also said that, you know, the focus is on bringing the inflation back in control. Now, I have two questions here. First, can the Fed really afford to go for another rate hike, given that the yields on the benchmark 10-year treasury note, which mind you is a key barometer for mortgage rates, auto loans and student debt, has hit a 5%, which is a 16-year high?
I think with all due respect, Suyash, Fed chair will be swinging between dove and hawks, let's face it, because of the situation that they have landed themselves into. And that may possibly preempt them to give statements accordingly. But the fact of the matter is that from the beginning of this year, we were aware about the situation in US and the rest of the world. So I really am not bothered about what US does or what the Fed chair does in terms of interest rates. Eventually, India will attract a lot of investment in terms of dollars. We are one of the best economies in the current situation and going forward into the future. I don't think, I always say this one particular sentence to all those who have concern about FIs and what the US is doing. You know, you can hate India, but you cannot ignore India.
All right, that's the view coming from Gaurang Shah. Mr. Shah, always a pleasure speaking to you, sir. Also, Amit, thank you for joining us in the studio.
Thank you, Mr. Shah.
But with that, we have completely run out of time on this edition of First Take.